Most people don't lose their retirement because of a crash. They lose it because of what they believed about crashes before the crash arrived. Let me give you a number that should bother you. In September of 1929, the Dow Jones peaked at 381 points. By July of 1932, it had fallen to 41. That's an 89% collapse, not 30%, not 50%, 89. And here's the part nobody tells you at the dinner table. If you were 55 years old when that crash happened and you held on, and you stayed disciplined, and you did everything the books tell you to do, you would have been 80 years old before the Dow returned to where it started. 25 years. November of 1954. That's not a recovery. That's a sentence. Now, I'm not telling you this to scare you. I'm telling you this because you are an adult and you deserve to hear what most financial commercials will never say out loud. The market does come back. Most of the time. Eventually. But eventually is a word that means something very different when you're 42 than when you're 62. And if you are watching this video, you already know that. You've seen 2000, you've seen 2008, you've watched a pandemic erase a third of the S&P 500 in 33 days, and then watched it climb back 5 months later like nothing ever happened. And somewhere in the back of your mind, a question has been forming. A quiet one. The kind you don't say out loud at parties. What if the next one doesn't come back in 5 months? What if it comes back in 5 years? What if it comes back in 25? This is where most people get it wrong. They think the danger is the crash. It isn't. The danger is the structure of the portfolio when the crash arrives. The danger is having one country, one sector, one decade-long bet carrying the entire weight of the life you've already paid for with your 40s. Let me show you the blueprint. Most people think a crash is the end of a story. It isn't. It's the beginning of one. And the story has 4 possible endings, not one. I want to walk you through them because if you understand these 4 shapes before we talk about anything else, the rest of this video will hit differently. You'll see the news the way professionals see it. You'll stop reacting to headlines and start reading them. The first shape is the V. The market falls, panic takes over, and then almost as quickly as it dropped, it climbs right back. You blink, and it's over. March 2020 was a V. The S&P 500 lost 34% in 33 days, the fastest bear market in American history, and was back at all-time highs by August. 5 months. If you had your eyes closed during the spring of 2020, by the time you opened them, the loss was gone. V-shaped recoveries feel like a gift, but here's what nobody talks about. V-shapes are the rarest of the 4. They almost never happen unless a central bank shows up with trillions of dollars within days of the crash. In 1987, after the market dropped 22% in a single Monday, Black Monday, the Federal Reserve announced overnight that it would inject whatever liquidity the system needed. The market recovered in about 19 months. That was a V too, but a slower one. V-shapes happen when the problem isn't structural. When the economy underneath the market is still intact and the fall was driven by panic or a single shock, the bounce can be violent. But if you build your retirement plan assuming every crash will be a V, you are betting your future on the rarest outcome in financial history. This is where most people get it wrong. The second shape is the U. The market falls, hits a bottom, and then sits there. For months. For years, sometimes. Slowly painfully, it begins to climb again. There is no fast snapback. There is just time and patience and a long flat line that tests every belief you ever held about investing. The financial crisis of 2008 was a U. The S&P 500 peaked in October of 2007 at 1,565. It bottomed in March of 2009 at 666. That's a 57% decline, and it took about 5.5 years, until 2013, for the market to fully recover. 5.5 years where every account statement you opened reminded you of what you used to have. 5.5 years of watching CNBC argue about whether this was the bottom, and then a new bottom, and then maybe this time it's the bottom. If you were 50 years old when Lehman Brothers collapsed and you held on, you were 55 by the time you were whole again. That's not a disaster, but it's not a recovery you can plan around either. It's a recovery that costs you half a decade of compound growth. The third shape is the W, and the W is cruel. The market falls, then climbs, then falls again, sometimes deeper than the first time. The people who held on through the first drop get rewarded for their patience. Then they get punished for it. The W is the shape that destroys faith. It's a shape that makes you swear off the stock market forever, right before the real recovery begins. The bear market of 1973 to 1974 was a W. The S&P 500 lost roughly 50% during the oil embargo, climbed back partway through the late 1970s, and then got hammered again by the second oil shock and the brutal interest rate hikes of the early 1980s. From peak to real recovery, adjusted for inflation, took about a decade. An entire decade of going sideways while inflation ate away at every dollar you saved. A magazine called Business Week ran a cover in 1979 titled "The Death of Equities." That's how bad it felt. Most readers nodded and agreed. Most readers were exactly wrong. The greatest bull market in American history started a few years later. But here's the thing about W's. They don't punish the people who panic. They punish the people who try to be smart. The investor who sold at the bottom of the first leg and missed the rebound, that hurts, but you learn from it. The investor who held through the first leg, sold during the rebound thinking they had learned their lesson, and then watched the market rally without them. That's the wound that doesn't heal. That's the person who tells their grandchildren stocks are a scam. The fourth shape is the L, and the L is the one nobody wants to talk about, because the L breaks the rule we comfort ourselves with. The rule that says markets always come back. Markets come back. Specific assets sometimes don't. Tulip bulbs in 1637 never came back. The South Sea Company in 1720 never came back. Individual stocks that were household names in 1929, Radio Corporation of America, Studebaker, the railroads that dominated the index, many of them never returned to their peak prices, ever. The Japanese stock market peaked in December of 1989 at 38,915 on the Nikkei. It did not return to that level until February of 2024. 34 years. If you were 55 in Tokyo in 1989 and you put your retirement into the Nikkei, you were 89 years old before the market made you whole. Most people who bought at that peak died before they broke even. That is the L. That is what happens when the asset at the center of the bubble was never worth what people paid for it. And here is the part the financial industry will not tell you out loud. The American stock market, broadly defined, has never had an L. But specific sectors have, specific countries have, specific decades have. The S&P 500 spent roughly 12 years going essentially nowhere between 2000 and 2013 once you adjust for inflation. That wasn't an L in the technical sense, but if you were retired during those years, drawing income from your portfolio, it sure felt like one. So now you have the four shapes: V, U, W, L: fast, slow, cruel, and permanent. And here is the question that should be living in the back of your mind from this moment on. If a crash arrived next year, not tomorrow, not in 10 years, but next year, which shape can your portfolio survive? A V? Almost any portfolio can survive a V. You barely have time to make a bad decision. A U? Most portfolios can survive a U if you're young enough. If you're 35 and the recovery takes 6 years, you have 25 more working years to rebuild. If you're 60 and starting Social Security in 2 years, those 6 years are exactly the years you needed to be drawing income, not waiting for a bounce. A W? A W requires not just patience, but conviction through 2 separate failures of patience. Almost nobody has that without a system. An L on a specific asset? If 30% of your money is concentrated in one company, one sector, or one country, an L on that bet is not a setback. It is the end of a particular version of your future. You don't need to predict which shape is coming. Nobody can. What you need is a portfolio that survives all 4. You don't need more money. You need a better plan. In the next block, I'm going to take you to New York in the summer of 1929, because the ingredients that built that crash are the same ingredients sitting on the table right now in 2026. And once you've seen them up close, you'll never read a financial headline the same way again. The summer of 1929 was the most optimistic summer in American history. I want you to feel that for a moment, because it matters. The economy had nearly doubled in size during the decade. Electricity was reaching homes that had never had it. Henry Ford's Model T had been replaced by something nicer, and the streets of every American city were filling up with automobiles. Radio was new. Jazz was new. A generation that had survived the trenches of World War I had come home and decided collectively that life was going to be different now. Better, looser, richer, and the place where all of that optimism collected, the place where the prosperity of the 1920s turned into a number you could watch tick up every single day, was the New York Stock Exchange. Newspapers printed the stock prices in bold. Radio stations interrupted programs with quotes. Barbershops had tickers. Shoeshine boys gave tips on which steel company was about to break out. The Dow Jones Industrial Average had climbed from 63 in 1921 to 381 by September of 1929, a 6-fold increase in 8 years. Everyone you knew had a story about someone who had become rich on stocks, and if they hadn't, they had a brother-in-law who had. You need to understand something about that moment, because it will matter to you when this moment arrives again, and it will arrive again. The 1929 market wasn't insane because people were stupid. The 1929 market was insane because everyone was right. For 9 straight years, the optimists had been right. The skeptics had been wrong. The people who had stayed in cash had watched their neighbors get rich, and most of them had finally given up and bought in at the top. In September of 1929, one of America's most famous economists, Irving Fisher of Yale, gave a speech in which he said stock prices had reached what looks like a permanently high plateau. He was not a fool. He was one of the most respected financial minds of his generation. And he was completely, catastrophically wrong. Here's the part nobody likes to talk about. The crash itself was bad. But it wasn't what destroyed America. What destroyed America was the leverage. In 1929, you could buy stocks on something called margin. You put up 10% of the price, and your broker lent you the other 90%. If you had $10,000 in cash, you could control $100,000 worth of stock. As long as the market kept going up, this was the closest thing to a perpetual motion machine the world had ever seen. A 10% rise in the market doubled your money. 2 such rises in a year tripled it. Your neighbor got richer than the doctor down the street. And the doctor noticed, and the doctor borrowed too. By the late 1920s, an estimated 1 out of every $3 in the American stock market was borrowed. Brokers, banks, even regional savings institutions were funneling cash into margin loans because the returns were so reliable. The Federal Reserve watched this happen and was reluctant to intervene. The party was good. Nobody wanted to be the one who turned off the music. Now let me show you what leverage actually does on the way down. Imagine a couple in Cleveland, 1929. Their name doesn't matter. Let's call them Frank and Margaret. Frank is 52. He owns a small printing business that's done well during the boom. He has $20,000 in savings, a substantial sum equivalent to roughly $370,000 today after inflation. His broker convinces him that the smart move is to put it all on margin. With $20,000 down, Frank controls $200,000 worth of stock. He's been watching his portfolio for 2 years. It's already doubled. He tells Margaret they'll be able to retire by 55. In September, the Dow hits 381. In October, it cracks. Black Monday, October 28th. The Dow drops 13% in a single day. Black Tuesday, October 29th. Another 12%. By mid-November, the market has lost half its value. Frank's $200,000 in stock is now worth $100,000. The math is brutal. He still owes the broker $180,000. He has been wiped out, and he is in debt for $80,000. His business is fine. His house is fine. But the savings he spent 20 years building are gone, and he owes the equivalent of 15 years of his previous salary to a broker who is calling him every morning. That story played out millions of times across America. And here's what most people miss. The worst part of 1929 wasn't October. October was just the first chapter. The Dow kept falling and falling. By July of 1932, almost 3 years later, the Dow closed at 41.22. It had lost 89% of its value from peak to trough. 89%. If you had $100,000 in stocks at the September peak and you held them all the way down, you had $11,000 left. And if you were on margin like Frank, you didn't have anything. You had debt. You already heard the recovery number in Block 1. The Dow didn't return to its 1929 peak until November of 1954. 25 years. But I want to put a finer point on that because I think it's where this story stops being history and starts being personal. If you were 40 years old in September of 1929, full of optimism, with 30 years of working life still ahead of you, You were 65 when the market made you whole. You were 65. You had spent your entire prime earning life, your 40s, your 50s, your early 60s, waiting for a number on a piece of paper to return to where it had been when you were a younger man. That's not an investment loss. That's a life rerouted. And let me ask you something honest. Imagine that's you. You're 42 watching this video. Imagine the next September is 1929. Imagine you held on. Imagine you did everything right. Could your retirement plan survive the math of getting whole at 67 instead of getting rich at 65? For most Americans watching this, the honest answer is no. Not because they're bad at investing, because they don't have a structure built to absorb that kind of time. And that gap between the structure they have and the structure they need is the thing this video is about. Now, I'm not telling you 2026 is 1929. It almost certainly isn't. The Federal Reserve in 2026 is a completely different institution than it was in 1929. The banking system is different. Margin rules are different. The government's willingness to intervene is on a different planet. The same crash with the same ingredients would not produce the same outcome today. But the ingredients, the leverage, the optimism, the certainty that this time the rules are different, those don't change. They are not financial. They are human. And the next block is where they show up again, in a decade you've probably forgotten about. But that has more to teach you about your own portfolio than any other in modern American history. I want to take you to a year you've probably never thought about as a turning point in your financial life. 1973. If you're 55 today, you were a kid when it happened. If you're 65, you remember the gas lines, but maybe not the stock charts. And if you're younger than that, the 1970s probably exist in your mind as a decade of bad haircuts, disco, and a vague sense that something was off. But the 1970s, specifically the bear market that ran from January of 1973 through the early 1980s, is the single most important decade in modern American financial history for someone planning the second half of their adult life. And I'll tell you why in a moment. In October of 1973, the Arab members of OPEC announced an oil embargo against the United States. The price of a barrel of oil quadrupled in a matter of months. Gas stations ran out of fuel. There were lines around the block in New Jersey and Ohio and California. People sat in their cars for 2 hours to fill a tank. The president went on television and asked Americans to lower their thermostats and stop driving on Sundays. And the stock market, which had been celebrating a decade of post-war prosperity, began to fall. And fall. And fall. From peak to trough, the S&P 500 lost roughly 48% of its value between January 1973 and October 1974. Adjusted for the brutal inflation of those years, the loss in real purchasing power was closer to 60%. But here's where the story gets interesting. The market didn't just crash and recover. It crashed, recovered partway, crashed again, recovered partway, and crashed a third time. The 1970s were the textbook W I described in Block 2. Except this W had 3 legs, not 2. And each leg punished a different kind of investor. The first leg punished the optimists, the people who had ridden the 1960s bull market and assumed the 1970s would be the same. They held through 1973, watched their statements get cut in half, and finally sold in late 1974 when they couldn't take it anymore. The market bottomed almost the week they capitulated. The second leg punished the brave. The investors who bought after the 1974 bottom, and there were some, watched the market rally 76% over the next 2 years. They felt smart, they felt vindicated. And then in 1979, when the Iranian Revolution triggered the second oil shock, the market sold off again and inflation jumped back to 13%. The brave ones, watching their gains evaporate a second time, sold. And again, the market bottomed almost the week they sold. The third leg punished the patient. By the early 1980s, Paul Volcker, the new chairman of the Federal Reserve, had decided the only way to kill inflation was to raise interest rates to levels that had never been seen in American history. He took the federal funds rate to 20%. 20%. To put that in perspective, mortgage rates in 1981 hit 18%. Try buying a house at 18%. Try running a business when borrowing costs that much. Volcker broke inflation, but in the process he triggered a brutal recession and another stock market decline. The patient ones, the ones who had survived the first two legs of the W, finally sold during the 1981-82 downturn. They were exhausted. They were done. In August of 1979, the financial magazine Business Week published a cover story called "The Death of Equities." The article argued that stocks were finished as an investment class, that inflation had permanently destroyed the math of stock ownership, that a whole generation of Americans had lost faith in the market and would never come back. The cover became one of the most famous in publishing history. Not because it was right, but because it was published almost exactly at the bottom. The moment Business Week declared stocks dead, the greatest bull market in American history was about to begin. From August of 1982 through August of 2000, the S&P 500 returned roughly 1,500%. The patient ones who held on through 1981 to 82 went on to become wealthy. The patient ones who sold in 1981 to 82, and there were millions of them, locked in 9 years of pain and missed 18 years of gains. This is the cruelty of the W. It doesn't reward conviction, it tests it, twice, sometimes 3 times, and every test feels like the final one. Now I want you to think about something that I think most financial content avoids because it's uncomfortable. Imagine a couple in Tampa, 1973. He's 52, she's 50. He's a regional sales manager for a manufacturer. She teaches 3rd grade. They have $80,000 in savings, a real amount of money in 1973, equivalent to roughly $590,000 today. They have 2 kids, one in college and one a sophomore in high school. They're not rich. They are doing the thing every middle-class American family in 1973 was told to do: save, invest, work hard, retire at 65. In 1973, their portfolio drops 22%. They hold on. In 1974, it drops another 33%. Their $80,000 is now worth about $42,000. They sell. They put what's left in a savings account that pays 5% interest, which sounds fine until you realize inflation is 11%. Every year their money sits in that account, it loses 6% of its purchasing power. Quietly, invisibly. The number on the statement looks fine. The buying power evaporates. By 1982, when the bull market starts, they're 61 and 59. They've watched 2 of their kids' weddings on a budget. They've canceled the trip to Europe they had planned for their 30th anniversary. He's still working. He had planned to retire at 65, but now he's thinking 70, maybe 72. Their financial advisor, they finally got one in 1985, tells them they need to get back into stocks. They look at him like he's insane. They have just spent 12 years being punished by the stock market. They are never going back in. They miss the entire bull market of the 1980s and 1990s. He works until he's 71. They retire on Social Security and a small pension. They are not poor, but they are not who they planned to be at 65. That's not a failure of intelligence. That's not a failure of discipline. That is a failure of structure. They had a portfolio designed for one shape of recovery, and the 1970s gave them a different one. They had a plan that depended on the market being kind to their specific 12-year window, and the market wasn't kind. This is where most people get it wrong about the 1970s. They look at it as a story about inflation, or oil, or politics. It's not. It's a story about the gap between an investor's time horizon and the market's mood. And that gap is the single most dangerous thing in your financial life right now. If you are over 40, when you're 25, you can be wrong about an entire decade and still recover. When you're 55, you don't have an entire decade to be wrong about. If you fix this, everything changes. The way you fix it is not by getting smarter about predictions. It's by building a portfolio that doesn't require predictions to survive. In the next block, I'm going to take you to 2 crises back to back: the dot-com bubble in 2000 and the housing collapse in 2008. Because together, those 2 crises gave us the playbook the central banks of the world are still using today. And that playbook, whether you realize it or not, is shaping the value of every dollar you own right now. I want to tell you a story about 2 crises that look completely different on the surface, but together they explain almost everything about the world your money lives in today. Let's start in March of 2000. The Nasdaq had risen from roughly 1,000 in 1995 to over 5,000 by March of 2000. That's a 400% gain in 5 years. Companies that sold nothing, made nothing, and had never earned a dollar of profit were valued at billions. The phrase that defined the era was, "This time it's different." A new economy was emerging. The old rules, profitability, cash flow, price-to-earnings ratios, those were for old economy companies. The new economy ran on eyeballs, on clicks, on something called page views. Pets.com spent $11 million on a Super Bowl commercial in February of 2000. 9 months later, the company was bankrupt. Webvan raised $375 million to deliver groceries from warehouses, and it folded without ever turning a profit. eToys, Boo.com, Cosmo, Flues, names that nobody remembers now because there's nothing left to remember. Billions of dollars vaporized into the corporate equivalent of nothing. The Nasdaq peaked on March 10, 2000 at 5,048. By October of 2002, 2.5 years later, it had fallen to 1,114. That's a 78% decline. Not 20%, not 50%, 78. And here's the part that matters most for you. The Nasdaq did not return to its March 2000 peak until April of 2015. 15 years. If you were 50 in 2000 and you had your retirement in tech stocks, you were 65 by the time the Nasdaq made you whole. You spent your entire working decade, your 50s, the decade that's supposed to be your peak earning years, watching a number on a piece of paper slowly climb back to where it had been when you were a younger man. The S&P 500 was less brutal. It lost 49%, but it was no kinder. It bottomed in October of 2002, and then, just as it was finally clawing its way back, the housing crisis started building underneath the recovery. The S&P didn't return to its March 2000 peak until May of 2013. 13 years of essentially nothing once you factor in inflation. We call that period the lost decade, and the name is generous. Now here's where the story gets important because of what came next. When the dot-com bubble popped, the Federal Reserve responded the way central banks always respond, by cutting interest rates. The Fed funds rate dropped from 6.5% in 2000 to 1% by 2003. Cheap money. Borrowing got nearly free, and cheap money has to go somewhere. It always does. It is the most reliable rule in finance. When central banks make money cheap, money does not sit still. It moves to whatever asset class still looks safe and still looks like it can go up. In 2003, after the trauma of the Nasdaq collapse, nobody wanted technology stocks anymore. They wanted something they could touch, something tangible, something solid. And what's more tangible than a house? American real estate had risen for 60 straight years. Not every market, not every year, but in aggregate, the trend was unbroken. By 2005, an entire generation of bankers and brokers had built their careers on a single assumption. House prices don't fall nationally. Some markets cool, some neighborhoods stagnate, but on a national average, never. It was treated as a law of nature, so banks started lending money to people who couldn't pay it back. Not by accident, by design. The mortgage industry invented a product called the Ninja Loan. No income, no job, no assets. You wanted a house? Sign here. The bank wasn't worried about whether you could pay because the bank wasn't going to hold the loan. The bank was going to sell the loan, packaged with thousands of other loans, to investors around the world. German banks bought them. Japanese pension funds bought them. Brazilian investment trusts bought them. They were rated AAA by the rating agencies, the same rating given to U.S. Treasury bonds, because everyone knew American houses didn't fall in price until they did. In 2006, home prices stopped rising. In 2007, they started falling. The packages of mortgages that everyone had bought, collateralized debt obligations, mortgage-backed securities, all the acronyms that nobody really understood, started becoming worthless, and because nobody knew exactly which packages held which bad loans, nobody trusted anyone. Banks stopped lending to each other. Credit froze. On September 15, 2008, at roughly 1:45 in the morning, Lehman Brothers, a 158-year-old American investment bank that had survived the Civil War, 2 world wars, the Great Depression, and the dot-com collapse, filed for bankruptcy. The S&P 500 fell from a peak of 1,565 in October of 2007 to a low of 666 in March of 2009, a 57% decline. If you had $200,000 invested in October of 2007, you had about $86,000 in March of 2009. Recovery took about 5.5 years. A U-shape. Long, painful, but eventually whole. But here's the part that changed the world. The response to 2008 was unlike anything that had ever happened before. The Federal Reserve cut interest rates to essentially zero. Not low, zero. And when zero wasn't enough, the Fed did something that in 2007 would have seemed like science fiction. It created money, not metaphorically, literally. The Fed announced it would buy trillions of dollars of treasury bonds and mortgage-backed securities on the open market, and it would pay for these purchases with dollars that did not previously exist. They called it quantitative easing, the polite name. The honest name is that the central bank typed numbers into a computer and those numbers became real American dollars. Between 2008 and 2014, the Fed's balance sheet went from roughly $900 billion to about $4.5 trillion. That's the amount of new money created out of nothing in 6 years. And it worked. The banks stabilized, the stock market recovered, the economy slowly came back. But the dollars stayed. They didn't go back into the box they came from. And once a central bank discovers it can solve a financial crisis by printing money, it cannot undiscover that. The tool stays on the shelf. In March of 2020, when a virus shut down the global economy and the S&P 500 lost 34% in 33 days, the Federal Reserve reached for the shelf. And this time, it didn't reach gently. Between February of 2020 and April of 2022, the Fed's balance sheet went from $4.2 trillion to nearly $9 trillion. The U.S. money supply, the M2 measure, the broad measure of dollars circulating in the American economy, grew by roughly 40% in about 2 years. In the history of the United States, there has never been a money creation event like it. Not in wartime, not in the Depression, never. The market recovered in 5 months. A perfect V. Faster than 1987. Faster than anyone alive had ever seen. And here's the question almost nobody asks. Where did all that money go? Some of it went into the real economy, into stimulus checks, into PPP loans, into propping up businesses that would otherwise have failed. But trillions of dollars also went somewhere else. They went into asset prices, stocks, real estate, bonds, cryptocurrency. Everything that could be priced went up because there were suddenly more dollars chasing the same number of things. Between March of 2020 and the end of 2021, the S&P 500 nearly doubled. American home prices rose roughly 40% in 2 years, the fastest housing appreciation in modern American history. The average price of a single-family home in the United States went from about $320,000 to $440,000. If you owned assets, you got richer. If you didn't, you watched a generation of wealth building get harder, faster, in real time. Now here's the question I want you to sit with. If a 34% stock market crash and a brief pandemic required $9 trillion of central bank intervention to fix in 5 months, what does the next crisis require? 12 trillion? 15? 20? At what point does the cure stop working? Nobody knows. That's the honest answer. The Federal Reserve doesn't know. The Treasury doesn't know. The economists on television who tell you they know, they don't know either. What we do know is that every dollar of money created has to live somewhere. And right now, in 2026, an enormous amount of that money is living in the prices of American stocks, particularly in a handful of very large American companies. Which brings us to where we actually are. The state of the market in 2026, what the data actually says, and what most of the financial industry is too polite to mention out loud. That's where we're going next, and that's where this video stops being about history and starts being about you. Let's talk about where you actually are right now. As you watch this video, May of 2026, I'm going to give you 4 numbers, and then I'm going to tell you what they mean. And just as importantly, what they don't mean. Number 1, the Shiller PE ratio, also called the CAPE ratio, currently sits at 42. Robert Shiller is the Yale economist who won the Nobel Prize in 2013 for his work on asset prices, and the ratio is named after him. It takes the price of the S&P 500 and divides it by the average inflation-adjusted earnings of the last 10 years. It smooths out the noise. It tells you, in a single number, how expensive American stocks are relative to the actual profits the companies underneath them have produced. The long-term average of the Shiller PE, going back to 1881, 145 years of data, is about 17. Today we're at 42. In the history of this metric, there has been exactly one time the number was higher than where it sits today. That was December of 1999, at the absolute peak of the dot-com bubble, when it reached 44. In September of 1929, before the crash that took 25 years to recover from, the ratio was around 30. Right now, in May of 2026, American stocks are more expensive by this measure than they were in 1929. More expensive than they were in 2007. More expensive than at any moment in the last 145 years except one. Number 2. The 10 largest companies in the S&P 500 currently account for roughly 40% of the entire index. The average for the last 30 years is 25%. In 2010, it was about 19%. So in 16 years, concentration in the S&P 500 has more than doubled and now sits at the highest level ever recorded in the index's history. If you own a standard S&P 500 index fund, the foundation of most American retirement accounts, and you put $100,000 into it today, $40,000 of your money is going into just 10 companies. The other $60,000 is spread across 490 companies. That is not what most people think of when they think of diversification. Number 3, of those top 10 companies, 8 are either technology firms or firms whose valuation depends almost entirely on the success of artificial intelligence. NVIDIA alone, the chip company at the center of the AI build-out, is roughly 7.5% of the S&P 500 by itself. To put that in context, in the year 2000, at the peak of the dot-com bubble, Microsoft, Cisco, and Intel together were about 11% of the index. Today, NVIDIA alone is 2/3 of what those 3 giants represented at the peak of the largest tech bubble in American history. And that's one company. The top 10 companies in the S&P 500 today are trading at roughly 30 times forward earnings estimates. The other 490 companies are trading at roughly 20 times. That's a 50% valuation premium for the giants, a premium that requires those giants to keep delivering the kind of growth that justifies it year after year, decade after decade. Number 4, the most important one. According to the major valuation models, including ones developed by Shiller himself, the implied annual return for the S&P 500 over the next 10 years, starting from today's prices, is approximately 1.5%. Not 10%, not 7%, 1.5%. That's the model's best guess. It could be wrong. It has been wrong before, but that's what the numbers say when you plug them into the equations that have historically been more right than wrong. Now, here is where I need to be honest with you because most financial content is not. None of these numbers tell you when a crash is coming. None of them. Robert Shiller has been warning about elevated valuations since 2014. The market has roughly tripled since then. John Maynard Keynes, the economist, once said, "The market can remain irrational longer than you can remain solvent." That is the single most important sentence in this entire video. You can be exactly right about what is wrong with the market, and you can still be financially destroyed by being right too early. Remember Michael Burry, the investor played by Christian Bale in The Big Short. He correctly identified the housing bubble in 2005, 3 years before it collapsed. His investors threatened to sue him. They withdrew capital. They called him a fraud. He had to literally lock the fund to prevent them from pulling out before the trade paid off. Burry was right. Eventually, in 2008, he made over $700 million. But he was nearly destroyed by being right too early. Most people, if they had taken his trade in 2005, would have lost their nerve by 2007 and missed the entire payoff. Most people sold in 2007 thinking they had been wrong all along. So I'm not telling you that a crash is coming next month or next year or even in this decade. Nobody knows that. What I am telling you is what the numbers actually say, and what they say is this: starting prices matter. Mathematically, the higher the Shiller PE when you invest, the lower your returns over the following 10 and 20 years tend to be. Not always, not in a straight line, but on average, persistently, across 145 years of data. If you invested at a Shiller PE of 17, the historical average, your subsequent 10-year returns averaged about 6.6% per year, above inflation. If you invested at a Shiller PE of 30, like 1929, your subsequent 10-year returns averaged closer to 2%. If you invested at a Shiller PE of 44, like 2000, your subsequent 10-year returns averaged approximately 0. That's the math. You can argue with it. You can hope this time is different. But that's the historical relationship, and it has held for 145 years. So what does this mean for you practically? If you're 47 or 54 or 61, and you've been doing what every financial advisor for the last decade has told you to do, which is mostly buy and hold the S&P 500, it means 3 things, and I want you to hear them clearly. First, it does not mean sell everything. Selling everything to try to time a crash is one of the most reliably destructive things an investor can do. Markets at expensive valuations can stay expensive for years. The cost of being out of the market during those years often exceeds the cost of riding out a correction when it finally comes. Second, It means that the assumption you have probably been making that the next 10 years will look like the last 10 is, according to every mathematical model that has ever existed, probably wrong. The last 10 years gave American stock investors about 12.6% per year, well above the historical average. That kind of return, starting from these valuations, is not what the models predict for the next decade. You can hope for it. You should not plan for it. Third, and most importantly, it means that the structure of your portfolio matters more right now than at any point in the last 25 years. Not because a crash is imminent, but because the math of high starting valuations is unforgiving. A portfolio that is 100% S&P 500 or 90% S&P 510% bonds is taking a very particular bet that the most concentrated, most expensive American stock market in modern history will deliver the same returns going forward that it has delivered going backward. Maybe it will. The models say probably not. And if it doesn't, the difference between probably not and definitely not will be paid for in real money by your retirement. In the next block, I'm going to show you what a portfolio actually looks like when it's built to survive all four shapes, V, U, W, and L, without requiring you to predict which one is coming. This is the piece I promised you at the start, the blueprint. And I'll be honest with you about what it can do and what it can't. Before I show you the blueprint, I want to thank you for staying with me this far. Most viewers don't make it past the first 3 minutes of a video like this. You've stayed for the data, the history, the math. That tells me something about you. It tells me you're not looking for hype. You're looking for the truth, and you're willing to sit with it long enough to understand it. That is rare. If you've found value in what we've covered so far, I'd ask you to do one thing right now. Hit the subscribe button. This channel exists to tell American adults over 40 the kind of financial truth the industry usually softens or hides. Subscribing tells the algorithm to send these conversations to other people who need them. Your neighbor, your brother-in-law, the coworker who keeps asking you whether they should sell everything before the election. Subscribe. Hit the bell so you don't miss the next one, and let's keep building this. Now, the blueprint. I'm going to give you the framework I use to think about retirement stage portfolios. Not a stock tip, not a model portfolio. A way of thinking about money that survives all four shapes, V, U, W, and L, without requiring you to predict which one is coming. It's built on a single principle, and the principle is this. A portfolio that needs to be right about the future is a portfolio that will eventually be wrong about the future. Most American retirement portfolios, as they actually exist in 2026, are built on 3 or 4 implicit predictions. They predict that American stocks will continue to outperform the rest of the world. They predict that interest rates will stay roughly where they are. They predict that the dollar will retain its purchasing power. They predict that AI will deliver on the earnings expectations currently built into mega-cap tech valuations. Some of those predictions may turn out to be right, some may not. But a portfolio that requires all of them to be right is not diversified. It is a single, very large bet, wearing the costume of diversification. The blueprint is built on 4 pillars, not because 4 is magic, because each pillar behaves differently in each of the 4 crisis shapes, and together they form something that doesn't depend on any single prediction being correct. Pillar 1 is productive equity. This is your ownership stake in businesses that produce real cash flow, not just the S&P 500, and this is where most American portfolios are wrong right now. Productive equity means American stocks, yes, but also international stocks, and within American stocks, it means looking past the top 10 names. In 2026, given the concentration we just talked about, this might mean owning the S&P 500 equal-weighted version alongside the standard one. It might mean adding international developed markets, where Shiller PEs are in the high teens instead of the low 40s. It might mean owning small cap value, which historically has outperformed during the decade after every previous valuation peak. The point isn't which specific funds. The point is that stocks should not mean the same 10 American technology companies in a trench coat. Pillar 2 is real assets. This is the part of your portfolio that exists outside the financial system, that you can touch or that's backed by something physical. Your primary residence, if you own one, counts here, though only partially because you have to live somewhere. Beyond that, real assets means real estate investment trusts, or REITs, that own actual buildings producing actual rent. It means commodity exposure in modest amounts. It means infrastructure, pipelines, utilities, the unglamorous companies that own the physical bones of the economy. Real assets exist precisely because of what we covered in Block 5. The era of money created from nothing. When central banks expand the money supply, real assets tend to hold their purchasing power better than the financial assets that exist only as digits in a database. Real assets are your hedge against a currency that may not be worth in 2036 what it's worth today. Pillar 3 is defensive capital. This is the most misunderstood pillar in modern American finance because for 15 years, from 2008 to 2022, defensive capital paid you almost nothing. Cash earned zero. Bonds earned almost nothing. A whole generation of investors learned that holding anything other than stocks was a tax on returns. That world is gone. In 2026, short-term treasuries pay roughly 4%. That's a real return after inflation for the first time in a generation. Defensive capital, high-quality short and intermediate treasuries, money market funds, certificates of deposit, I-bonds for what they're worth, is the pillar that lets you sleep through a 50% crash without selling stocks at the bottom. It's also the pillar that lets you buy stocks during the crash when everyone else is selling. This is where a portfolio earns the right to be brave. How much should be in defensive capital? Here's the honest answer, and most of the industry won't give it to you. Enough to cover at least 3 years of your essential expenses without selling a single share of stock. For most American couples in their 50s and 60s, that's a substantial number. It might be 25% of the portfolio. It might be 35%. The exact number depends on your spending, your other income, and your sleep. But the principle is non-negotiable. Defensive capital is what makes you a long-term investor in practice, not just in theory. Without it, you are one bad quarter from making the worst decision of your financial life. Pillar 4 is what I call asymmetric exposure. This is the smallest pillar, usually 5 to 10%, and the most controversial. It's the part of your portfolio designed to do something different from everything else. Gold falls in this category. Some long volatility strategies, a small allocation to companies that benefit from chaos rather than calm. The point of Pillar 4 is not to make money in normal times. The point is to provide a source of liquidity and stability when everything else is falling at once. In 2008, gold rose while stocks crashed. In 1973, gold rose while both stocks and bonds got hammered. Pillar 4 is the small allocation that gives you something to sell when the news is at its worst. Now, here's the part where I need to be honest about what this blueprint can do and what it can't. This blueprint will not make you rich during a roaring bull market. If the next 10 years deliver another 12% annual return on the S&P 500, a portfolio built like this will underperform. It will probably do 8%, maybe 9%. The cost of preparing for all 4 crisis shapes is that you give up some upside in the shape where there isn't a crisis at all. That's not a bug. That's the price. This blueprint will not protect you from a market that goes nowhere for 10 years. Nothing protects you from that except time. What it will do is keep you in the game during those 10 years, so that when the market does eventually move, you're still there to participate. This blueprint will not make decisions for you. It is a framework, not a formula. The specific percentages, the specific funds, the specific tax treatment for your situation, those require either real work on your part or a real fiduciary advisor. If you don't have one and you're managing $500,000 or more in retirement assets, please consider this. A fee-only fiduciary paid by the hour or by the project is one of the highest return purchases you can make in your 50s and 60s. Not a commission salesman. A fiduciary, legally obligated to act in your interest. The difference is everything. What the blueprint will do, what I've watched it do for thousands of American families now in their 60s and 70s, is keep them invested during crashes, prevent them from buying at peaks, and protect their capacity to live the second half of their lives without rerouting their retirement around someone else's mistake. In the next video in this series, I'm going to take you deeper into Pillar 3, defensive capital, and answer the question that almost no financial commercial in America will answer honestly. How much cash should you actually hold? And where should you hold it? Because the answer in 2026 is dramatically different from the answer in 2019. And most Americans are still working from the 2019 playbook. Subscribe, hit the bell, and I'll see you there. For now, let's go to where this whole video has been heading. The scene I want you to carry with you after this ends. There's a scene I want you to carry with you after this video ends. It's the year 2038, 12 years from now. You're 70-something, maybe early 60s if you're younger now, maybe mid-70s if you're a little older. You're standing in the kitchen of a house you've lived in for a long time. It's morning. The coffee is brewing. The light is coming in the way it always does. You're not thinking about anything in particular. You're just standing there in your own life. And here's the question I want you to ask yourself right now, before this video ends. In that kitchen, 12 years from now, which version of you is standing there? Let me show you the 2 versions, because I think they're more different than most Americans realize. Version 1. You're standing in the kitchen and the coffee is brewing, and you're thinking about the trip you're taking next month. Not because you have to, because you want to. Your daughter is meeting you in Lisbon. She's been there twice for work, and she keeps telling you the food is unreasonable. and your son is flying in from Denver to join you for the second week. You haven't checked your portfolio this morning. You haven't checked it in 3 weeks, actually, because there's no reason to. The blueprint did what blueprints do. There was a recession in 2029. There was a long flat stretch from 2031 to 2034 where the S&P 500 essentially went nowhere. You barely noticed because Pillar 3 was paying the bills and Pillar 2 was doing what real assets do when paper money is being printed. You stayed invested. You bought during the crash in 2029 because you had defensive capital to buy with. You're not rich exactly, you're free. There's a difference, and you can feel it in your chest when you stand in this kitchen. Version 2. You're standing in the kitchen, and the coffee is brewing, and you're thinking about the email you got yesterday from your son. He needs help with a down payment. He's careful about asking. He knows things are tight for you now. The crash in 2029 wasn't supposed to last this long, but the recovery shape wasn't a V. And you sold most of your stocks in early 2030 when it looked like things were about to get worse. You sold near the bottom, the way most people do. And you missed the partial recovery in 2031, and then the second leg down in 2032 made you grateful you had sold. By 2034, you realized you'd been wrong about all of it. The market eventually came back. You weren't in it. You're 68 now, and you're still working part-time, not because it gives you purpose, but because the math doesn't add up without it. You don't tell your son this when you call him. You tell him you'll figure something out. These two versions of you are not separated by intelligence. They are not separated by income or education or luck. The man and woman in version 1 and the man and woman in version 2 earned roughly the same amount of money during their working lives. They saved roughly the same percentage of it. They are equally smart, equally hardworking, equally decent. The only thing that separates them is the structure of the portfolio they had in 2026. That's it. That's the whole video. You can spend the next 10 years trying to predict the next crash. Some very smart people will do that, and most of them will be wrong, and a few of them will be right at exactly the wrong time. You can spend the next 10 years trying to time the top of the AI rally. People will do that, and most of them will sell too early or too late, and the ones who get it right will have done it by luck and won't be able to repeat it. You can spend the next 10 years following the loudest financial personalities on social media, who will tell you, with great confidence, completely contradictory things every single week. Or you can do something quieter. You can sit down this weekend, look at your actual portfolio, not the version of it you tell people about at dinner, the actual one, and ask yourself one question. If a recession arrived in November and lasted 6 years, would my plan survive it? Not would the market recover. The market will probably recover. The question is whether you would still be in the market when it did. If the answer is yes, you're closer to version 1 than you think. Tighten what needs tightening and keep going. If the answer is no, or if the answer is I don't know, you have work to do, not panicked work. Quiet, deliberate, adult work. The kind of work that 12 years from now will be the reason you're standing in the kitchen thinking about Lisbon instead of about the email. I have 3 things I want to ask of you before I go. The first is the same as before. Subscribe to this channel. Hit the bell. We're building something here for adults who are tired of being talked down to by the financial industry And the only way it grows is by showing the algorithm that videos like this matter to people like you. The second is harder. I want you to share this video with 5 people. Not because I need the views, though I'm grateful for them. Because somewhere in your life there are 5 Americans over 40 who are exactly the people version 2 happens to. They're not stupid. They're not careless. They just haven't seen the math laid out like this, in plain English, without someone trying to sell them a course at the end. Send this video to them. Send it to your sister. Send it to the guy from work who keeps talking about Nvidia. Send it to the cousin who told you at Thanksgiving that bonds are dead. You don't have to say anything, just send it. Let the math do the work. The third thing, leave a comment. Tell me which version of you is standing in that kitchen in 2038, version 1 or version 2. And tell me what specifically scares you about the gap between where you are now and where you want to be. I read the comments. Not all of them, I'm not going to lie to you, but more than you'd think, and the comments shape the next video and the one after that. This is a conversation, not a broadcast. Make it one. Here's where I leave you. The market does not care about you. It does not know your name. It does not know how old you are, or what you've sacrificed, or how much time you have left. You are the one who has to know those things. You are the one who has to build the portfolio that does. Subscribe, share, comment. I'll see you in the next one.